One of the most common questions that I get from clients is, how do I get more of my assets into a Roth IRA? Or should I convert IRA assets into Roth IRA? This is especially a common question from clients who are in those higher income tax brackets and or states that also have a state income tax. And it's a pretty complex answer that really requires looking into a lot of different variables around your life, your income, and your future plans. I'm Andrew Constantinides. I'm a CFP at Neil Jesani Wealth, and in this video, I want to talk about Roth conversions and if it makes sense to convert IRA assets over into Roth IRA assets. And I think a good starting point would be, why would anyone want to do this and what is the benefit? And I think from there you start with the difference between traditional IRA assets. The 401k would also have the same tax implications as a traditional IRA versus the Roth IRA. So 401k and IRA, when you make a contribution to that account type, you're able to deduct that contribution from your income for the year, which is going to reduce your income and thus reduce your tax liability at the end of the year when you file your return. That money in the IRA account now grows tax deferred. So any capital gains or income generated in that account is not going to appear on your tax return every year when you file it. However, you can't do anything with that money until you're 59 and a half. If you take money out before then, not only are you going to get hit with income taxes for that year, but you're going to get hit with a penalty. So after you're 59 and a half, you can take withdrawals from your IRA or your 401k. However, it's going to be taxed at your ordinary income tax bracket for that year in which you take it out. So if you're, let's just say, 60 years old, and your income is $250,000 per year, you're going to be getting taxed at a pretty high bracket on anything that you take out of that IRA. If you're at the 27% tax bracket, you take $10,000 out of your IRA, you're going to owe $2,700 in taxes. So this is the main reason why the Roth IRA is so attractive. When you make a contribution to a Roth IRA or a conversion, basically just putting money into a Roth IRA, you don't get a tax deduction for the year in which you make it. So it's considered after-tax contribution. So you're paying the tax now, pushing it into the Roth IRA, but now that money, those dollars, will never be taxed again. That includes the growth on the investments, the income generated from the investments, and probably best of all, when you're over 59 and a half and you take that money out, no income tax at all. So having assets in a Roth IRA allows for a lot of tax planning. Maybe you have other assets that are generating income in a portfolio that, as a financial planner, we set it up so that, let's say we're going to pull $200,000 of income from the IRA or the taxable portfolio. Anything over that is going to come from the Roth IRA. So you're managing the tax bracket and not pushing the client into those highest tax brackets. So that's really the appeal of a Roth IRA. But when it comes to getting money into the Roth, there's a couple ways. So one of the best ways is through your employer's 401k, which for 2025, if they offer a Roth component to it, you can put up to $23,500 into that Roth 401k. Where if you didn't have an employer plan and you just wanted to make a contribution to a Roth IRA, that's limited to $7,500 per year. And that also phases out. So depending on if you file single or joint, you may not be allowed to contribute to a Roth IRA. If you're filing single and you make over $165,000 per year, Roth IRA contribution is out. You can't put $7,500 into it. And if you file jointly and make over $246,000 per year as a couple, it's out. You can't do the Roth contribution. So this brings us to the Roth conversion and what it actually is. The IRS allows you to take money out of your IRA before you're 59 and a half, so you wouldn't have a penalty, and convert it into a Roth IRA. So let's just use the example of $100,000. Let's say in 2025, you take $100,000, convert it into your Roth IRA, out of your IRA, you're going to be taxed that $100,000 at ordinary income rates for this year. So if you're already making $300,000 or $400,000 per year and are up in those higher tax brackets, and you convert $100,000 over to the Roth, you've just increased your income by $100,000, which is already getting taxed at those higher tax brackets, whether it's 32, 34, or 37. So there's been kind of a lot of studies and forecasting done on at what tax bracket does it make sense to convert IRA over to Roth IRA at. And what I've generally found is that if you're at the 27% tax bracket or higher, you generally probably don't want to convert to a Roth IRA. A lot of clients seem to want to do it anyway because the concept is taxes are just going to be higher in the future when you're in retirement and you're taking that money out of the IRA. But also maybe your income is going to be lower in retirement as well, so you won't get hit with those higher tax brackets through your IRA withdrawals. But generally 27% or more, you don't want to convert. Now, if there's a way where you could convert a certain amount of dollars every year from IRA to Roth to get you right up to that 27% tax bracket each year, let's say for the next 5 years, then that would make sense. So a lot of times the solution is, okay, we don't do a big conversion this year, but we do $30,000 this year. Depending on your income next year, maybe we can get $40,000 out next year. The third year, so we go by your income or estimated income for the year and convert whatever amount from the IRA into the Roth. It's not going to push you over that 27% tax bracket. It's a pretty complex case study, and there's a lot of variables based on your income, your future work plans, how much you have in the IRA, even what is your plan with your assets when you're gone. Another reason getting assets into the Roth is so popular is that if you pass on a traditional IRA or 401k to your beneficiaries, once those assets go to them, since the Secure Act in 2019, they have to draw those assets out over a 10-year period. They can't just let them sit in the IRA and grow untouched for 20, 30, 40 years. In the past, you could do that. Now it's 10 years. Your beneficiary has to take those IRA assets out within a 10-year period. When your beneficiary takes those assets out, they're also going to be taxed at ordinary income. So if your children are successful, which hopefully they are, and they're at a high income tax bracket, and now they have to take this money out of the IRA and add to their income in those years, that's not a sensible tax strategy. But the Roth IRA is different. Your beneficiary, if they receive Roth IRA assets, they can take the money out any year as fast or as slowly as they want, or let it grow, and they don't have to pay tax on those withdrawals. So a lot of different variables based on individual situations. It's really best to consult your financial advisor to get a full understanding of your picture and try to develop a plan on how you can maybe shift some assets over to Roth over a series of years into the future.